Good afternoon, and thank you for joining us today for buying or selling a Canadian food business, avoiding the pitfalls. I'm your host, Alex Jaretsky, Digital Marketing Coordinator at Annex Business Media, and I want to thank you for joining us today for this hour-long webinar. Big thank you to our sponsor, Kroll, for putting this webinar on. Before I introduce our speakers this afternoon, I'd like to take a moment to go over a few housekeeping items. Firstly, this webinar is being recorded, so if for any reason you have to leave early or you miss part of the presentation, a link to the recording will be emailed to all registrants in 24 hours. Secondly, questions can and should be submitted to the Q&A section at the bottom right of your screen and will be saved for the end of today's presentation. Without any further ado, I'd like to introduce our panelist for today, Dr. Howard E. Johnson. Dr. Johnson is a Managing Director and Head of Canadian M&A at Kroll Corporate Finance in Toronto. Dr. Howard has extensive experience in the food and beverage sector and was previously Corporate Planning Manager at Frito-Lay, and he's the author of several books on the subjects of corporate finance and valuation published by CPA Canada. Without any further ado, I'd like to pass it over to Howard for his presentation.
Okay, well, thank you, Alex, and thank you, everybody, for joining us today in that introduction. So, as Alex mentioned, I've been doing this for a long time, over 25 years, and before that, was corporate planning manager at Frito-Lay Canada. So I've certainly been on the inside, and it's led to doing a lot of work in the food and beverage sector. I think a copy of this presentation is available later, and as standard, there's always a disclaimer saying, if you do try this at home and it doesn't work out, please don't sue me. Look, for those of you who may not be familiar with Kroll, so Kroll is a global merger and acquisition advisory firm and general advisory firm. We have a whole bunch of divisions, including cybersecurity and valuation and so on. About 6,000 people around the world. And what I think makes our business unique is that it is globally seamless. So I work very collaboratively with my colleagues in the US, Europe, Asia, and so on. Whenever we're buying or selling a business, it really helps in getting that local presence along with a seamless global reach. So we're all very helpful to each other in ensuring the buyers or sellers are able to meet their overall objectives. And, just briefly, we've done a lot of work in the food and beverage industry over the past many years. This is just an example of a handful of transactions that we've been involved recently. There's many more. And look, after this presentation, if anyone is interested or wants to have a confidential discussion, all our initial discussions are totally confidential, no cost, no obligations. So if there's a situation that you want to talk about, we're very happy to have that with you. So without further ado, I want to use our time here together to really hop into the crux of our discussion about buying and selling the business, and more specifically, a food business. One of the things that I find is always helpful to start with is how are the number of transactions been trending over the course of the past few years. So we have a quarterly report called the Food and Beverage M&A Landscape. By the way, you can sign up for it, and we can distribute this every quarter. But we do track very carefully within North America the transaction activity that's going on, because it is a barometer. A lot of the transaction activity numbers come with the total value of transactions, and that kind of gets skewed. You get a handful of these big multi-billion-dollar deals, and it tends to skew things. I tend to look at the number of transactions as a better barometer for what's happening within a given industry. So as we can see in this chart, it's done by quarters, with the blue bar at the end being the most recent quarter. The number of food and beverage transactions in the third quarter of 2023 is down. And the reason for that was quite simple. You may all recall and know very well that interest rates started going up kind of the latter part of 2022 and into 2023. And that rise in interest rates caused a lot of corporate buyers and several sellers to be hesitant as to how far and how fast these interest rates were going to go. Are we going to have a deep recession, mild recession, and so on? And as a result of that, a lot of sell-side processes and buy-side initiatives were put on hold in the latter part of 2023 and the first quarter latter part of 2022 and the first quarter of 2023. And we're seeing that in the number of transactions now in the latter part of 2023. However, what has happened in real time, so looking at the second quarter and third quarter of 2023, the number of new transactions that are being launched. So we work very closely, as I mentioned, with our colleagues around the world, and they're always in touch with major private equity firms and major buyers. We're seeing a large spike right now in the number of sellers going to market, because while there's still uncertainty out there with a lot of geopolitical issues and so on, people, I think, have a bit better visibility than they did just 12 months ago, and that's allowed them to at least plan and therefore go to market. So I think that we've hit the trough, and you're going to see the numbers of transactions come up in the latter half of 2023 and into 2024. So I'd like to start today with on the sell side, right? So selling a business, and in particular a food company, and what are some of the things to think about? What are some of the pitfalls to avoid? Because these are obviously important. So the first place I like to start is just an overview of what the sale process typically looks like. And if you're on the buy side, I encourage you to think about how the seller is viewing their sell side perspective. And if you're on the if you're a seller, it's important to understand the buy side, because the understanding of the other side and the dynamics is what really brings a deal together. So on the sell side, really, I like to put it into two phases, if you will. The first is what I call the planning phase, and that's these building blocks you see on the screen. So these are things that you do before you go to market. Like, when's the best time to sell? How do I get my business ready for sale so it's attractive? What can I expect reasonably for value and price? So all these things can be done before you go to market. And when you go to market, and that's the squiggly line you see up here, it is a process of engaging buyers, and I call it engaging as opposed to contacting, because anybody can pick up a phone and contact a buyer, but how do you get the right people to the table? Conveying information to them and what not to provide them. Deal structuring and negotiation, and the all-important letter of intent that I'm going to touch on during this presentation today. And then you'll notice that inflection point toward closing. And that's because between the letter of intent and closing is the seller's risk zone, if you will, where there's greater chance of things going down than going up. So, the entire process, that squiggly line process, that's usually, 6 months, 9 months or so, give or take, between the time that you go to market and the time that the ink is dry. The planning phase could be many years, right? You should always be in a position where you are ready to sell, but you don't have to, because there's nothing like having the best alternative, which is having a good business just to run. So if we look at the first part, timing of the sale, in that regard, three things ideally have to align. Number one, the seller has to be ready. And when we're talking about privately held businesses and family-owned businesses or owner-managed businesses, which I deal with a lot, it's as much a personal decision as it is an economic decision. And the individual seller, of course, understandably, is going through a lot of very mixed emotions, because for that person, the sale of their business is oftentimes one of the biggest financial events and one of the biggest emotional events of their lifetime. The company also has to be ready. Right, so you have one chance to make a good first impression, and ideally M&A market conditions are favorable. So we saw just unbelievable conditions during 2021, into the first part of 2022, dropping toward the end of 2022, and then ramping up again as we exit 2023. And for 2024, looks good. I wouldn't say it's going to be at the peak where 2021 was, but certainly off its lows and moving in the right direction. So ideally, all these things align. And oftentimes, I'll get somebody come to my office and say, well, Howard, when is the best time to sell my business? And again, it's a personal decision. But from an economic perspective, I take them through this exercise. And I say, look, a lot of businesses go through a cycle that's kind of like this here, right? You'll notice I like these squiggly lines. And in this process, you have a couple of years where you're kind of bouncing around and things are okay. And then all of a sudden you have a big growth spurt and you get to the next plateau. And you tend to have two types of sellers. Seller number one is at the very early stage, and they say, hey, I've got a good business, but boy, I'm about to get into a whole bunch of new accounts, and I've got new products and geographic growth and everything else, and I want somebody to pay me for that. Well, for the most part, buyers don't pay for future expectations up front. Simply put, proof is worth more than promises. And so oftentimes the seller will say, geez, if I'm getting some multiple of cash flow or multiple of EBITDA, the acronym for earnings before interest, taxes, depreciation, and amortization, then I'm going to wait till I get to that next plateau, because that's where I'm going to have the highest cash flow and the highest value. Well, it doesn't always work that way, because while you may have a higher plateau once you've had that growth spurt, if there's no future growth, because remember, there's two parts here. There's the cash flow and the multiple. And the multiple, as we'll talk about in a little bit, is driven to a large degree by prospective growth. So buyers look at the past, but they apply a multiple based on what the future holds. And so when you get to a point where you're flat or declining, buyers tend to be less enthused. And as a result, the multiple tends to come down a bit. The ideal time to sell a business, and again, it's conceptual because you can never pinpoint it with accuracy, is when you're about 2/3 of the way up that line, because you've demonstrated you've had a couple of good years of growth, and it looks like next year is going to be better than this year. Why? Because you've just gotten some new accounts and you're just starting to do the fill-in, or you've just launched some new products and so on. This is all very helpful. And as a result, the buyers tend to be more interested in growing businesses. What does that mean? More buyers, better quality buyers, a better auction, and overall higher value. So that's something to keep in mind when you're thinking about timing. When you're preparing for the sale, you've got one chance to make a good first impression. And there's a number of things to keep in mind here. There's operational and financial structuring. The business has to look good. There's tax and estate planning. Look, there's three parties to every transaction: the buyer, the seller, the government. And if you don't do proper tax planning and you end up paying more taxes, you don't even get a thank you card. So it's well worth it. And getting the right people on your team, transaction advisors. So again, you want to make sure that before you go to market, you have a good looking business that a buyer is going to say, yes, I like that. And it's a nice, clean, simple deal. Make it easier for the buyer, makes it easier for the seller. So a couple of things that always come up. And number one is, if I'm thinking of selling, what do I tell my management team? Always a tough question. And, no easy answer. But oftentimes, here's the way it transpires. The owner goes to his or her management team, or key managers, CFO and chief operating officer and so on, and says, look, I'm thinking about selling or a liquidity event. I don't know what that's going to look like right now, which is always true at the outset because you don't know what's going to happen. However, I think you 3 or 4 managers are key, so I want you to help me through this process and to stick around with a new prospective buyer if they want you. And that business owner had better be ready for the next question, which is, what's in it for us? So one of the things to think about before you go to market is, how are you going to reward those key people in getting you through the process and maybe even sticking around afterwards? Because those people, if you take the poor CFO, he or she has to do both their day job and be inundated with a ton of requests. They're working nights, they're working weekends. They got to be rewarded. And if they want people to stay around afterwards, this might be a pay to stay bonus. There are different ways to structure it, but you have to have thought about it and maybe talk to your transaction advisor before you have that discussion so you're ready. Operational initiatives are also important, right? Like the website. Well, you don't have to spend $500,000 on a new website before going to market, but recognize that the website is the first place that a buyer is going to go when you decide to sell and they find out what the name of the company is. So make sure that it's consistent, it's clean, and so on. Your accounting and IT systems. So buyers will ask for tons of different information. If you have a very simplistic accounting and IT system, it may be difficult to answer some of those. Now, Going through a system conversion, of course, is a big undertaking, so you don't want to take that lightly, but there may be other ways to fill in the gap. And the more history that you can pull, right, the better prepared you are for those questions. Financial statements. Buyers are always focused on the financial statements, and sellers are always trying to get their EBITDA or their cash flow up, and buyers are always trying to look for reasons that the cash flow isn't that high. And one of the things is discretionary expenses, right? So you buy those season hockey tickets, for example, and when the CRA knocks on the door, you say, "Yep, they're for my suppliers and customers and so on." But to a buyer, you say, "Well, I take my buddies, I sometimes give them away, friends, etc." So if an expense is truly discretionary, it's better to demonstrate that the business can operate without it in the year or two before sale. So if you do have these discretionary expenses, ideally pull them out, right? Demonstrate that the business can operate without these other expenses, and that makes it a lot easier to get paid for it. Working capital management, always a big issue. Because when you sell a business, big or small, there is always the notion of this working capital peg. Well, what does that mean? Well, let's say you sell a business for $50 million. So the buyer and seller have to agree that with that $50 million, at the closing date, there has to be a certain level of working capital in the business. And if there's less working capital, the price gets pushed down. If there's more working capital, the price gets pushed up. So obviously, the seller wants a lower working capital peg and the buyer wants a higher one. So how is it usually measured? Well, buyers will usually look at the past monthly results for the past 24, 36 months and see how is your working capital trended versus your sales. So if you're allowing receivables to be uncollected for undue periods of time and inventory to go unsold and so on, it's going to inflate the working capital. And you might say to a buyer, "Well, geez, after closing, you guys can do a better job," and so on. The buyer's going to say, "Well, that may be true, but I'm not paying you for it." So manage the working capital, manage the balance sheet before you go to market, because that's going to be the benchmark that a buyer is going to use for this working capital peg. And if you can liquidate some working capital before going to market, you put that money right in your pocket. Capital spending management. Food processing companies in particular are capital intensive, and you tend to have two sets of sellers. Those that want the latest, greatest, shiniest equipment and think a buyer is going to pay them for a bunch of excess capacity, and that usually doesn't happen, right? It's like you don't remodel your kitchen before you sell your house. And the other side is that you go through the plant and everything's stuck together with duct tape. Well, that doesn't work because the buyer is going to ding you for the capex that you really need. So it's got to be that balance. It's got to be that balance. If you are doing a big capex plan just before you sell, and this is very common in food companies, we see it a lot. Oftentimes, if the buyer is going to reap the benefit of that, then the buyer and seller can agree that if the seller invests a few $1 million just before closing, that the buyer will compensate them for that in order to keep the business going. And real estate, right? If you own the real estate in which that houses the operations of your business, you may have two separate assets there. And real estate assets often trade at much higher multiples than operating companies. So make sure that you're not commingling the two unnecessarily and therefore diminishing the value of the real estate. And like I said, tax planning is always key and well worth it. If we move on to valuation, look, valuation is a whole topic on its own, but there's a couple of key things I want to touch on during our time today. It's about the cash flow, usually mentioned in EBITDA, so earnings before interest, taxes, depreciation, amortization, which is an imperfect measure at best, but it tends to be the most popular. Rates of return or multiples, those are just the inverse of each other. So if I say a 5 times multiple, it's a 20% rate of return, 1 divided by 5. And of course, the balance sheet, right? That extra working capital that you have on the balance sheet. So sometimes you can identify opportunities for value enhancement before you go to market. So a couple of things on the valuation side. Number one, what do I expect to sell my business for? Well, it's helpful to get a sense of value before you go to market so that you can assess whether the bids that you're receiving are within reason. But be very wary about terms like fair market value, because they make a whole bunch of simplistic assumptions that may be far different from price. In valuation, size matters. And at the end of the day, I have this rule of thumb that I call 2, 5, 10, 20. So very simply put, if you've got a business and it's generating less than $2 million of EBITDA, hey, it might be a great business. Nothing wrong with making $1 million a year. But chances are the buyer for that is going to be somebody that's already local. It's very difficult, for us to, pick up the phone and talk to our colleagues in Europe and say, hey, there's a great business in Canada, $1.5 million of EBITDA, Canadian, and so on. So they'll say, well, you know what, sounds nice, but we don't want to make a big footprint or spend a lot of time for, a smaller business. So once you hit 5 million of EBITDA, that's when you start to get more interest from, US and smaller private equity funds and so on. Once you hit 10 million of EBITDA, ideally 10 million US, the floodgates open. So everybody wants it, no shortage of interest, and the number of buyers influences value. Number of buyers is liquidity. Liquidity influences value. Once you go beyond that to 20 million, there's even another notch up where pension funds and others are getting involved. But the big thresholds are 5 million and 10 million, which is a question for both buyers and sellers. Do you wait till you get to that next threshold? Or if for example you're a buyer, do you try to find companies that are a little below that threshold, knowing that the competition will be a bit less? No right or wrong, it's a strategy. When customer concentration, especially in food companies, is always a concern, right? We have only a handful of grocers in Canada. And as a general rule of thumb, if you have one customer that's north of 20% of your revenues, you're considered to have concentration. And that does influence the multiple or the terms of the transaction, which we'll get to. Then we have this adjusted EBITDA. And as I said, EBITDA wins the popularity contest for valuation metrics. And it's normalized EBITDA. So what's normalized? Well, normalized is what you can convince the buyer you would ordinarily generate in a given year once you get rid of all the noise that oftentimes goes within a company. For example, you've got family members that are not as active as they could be, and therefore aren't necessary after a transaction, or you had some moving expenses that were one time, or product recall, things like that. So lots of gory detail. But also recognize the buyer's looking at things, and they are looking at things through the opposite lens. So by way of example, if they see that you've lost the customer account a few months ago, they're going to prorate that for the full year, right? And they're going to say, you lost that customer account 3 months ago, but for a full year, here's the impact. And everybody always looks at, rightly or wrongly, trailing 12 months EBITDA. And here's the kicker. As you're going through the process, rightly or wrongly, buyers tend to be laser focused on how did you do, in this October 2023 versus last October 2022, as if it's the most important parameter that they're looking at. And it just is the nature. So you would like ideally to demonstrate that you're going upwards. So this October is better than last October. This November is better than last November. So again, it's demonstrating that growth, because the multiple that they're paying for is the multiple of the future. If they believe that the cash flow is going higher, then in the buyer's mind, those multiples are going down. Lots of issue with multiples. Everybody wants to say, I want a multiple of 10 times this, 8 times that. And look, multiples are imperfect. You don't take a multiple to the bank. The question is always multiple of what? Worry more about the cash that you're getting. So there's a lot of hearsay about who got what multiple, and oftentimes those multiples can be misleading because they are normally based on unadjusted profitability, which may be wildly different than adjusted. But unless you're involved in the transaction, you don't really know. And of course, multiples have a growth element embedded in them. So growing companies fetch higher multiples. What I really want you to focus on is intangible value. So think about it. You're selling a business, and you're giving up two things. You're giving up what's on the balance sheet, so your working capital, your fixed assets, and so on. Yeah. And it's nice to get some money back for that because that's your investment in the business. But what are you getting beyond that? What is somebody really paying for your people, your customers, and your products? So your people, your customer, your products are the key. So if you can build those things up and get a premium for those things, that's where you create real shareholder value. Intangible value creation is the key to shareholder value realization. So engaging buyers, once you decide to go to market, you have to identify them. There's a way to contact them, get them to sign a non-disclosure. And by the way, non-disclosures are nice to have, but they're only as good as the people behind them. So don't put too much weight in them. Yes, you should have them, but they're not the be all and end all. I like to create, everybody likes to create an auction, but I like to count the number of serious qualified buyers on one hand, but not one finger, because you still got a business to run. And at the end of the day, if you're trying to deal with, 10 or 12 different groups, and I mean dealing with them at an advanced level, so taking them through management presentations, facility tours, and so on, it can become a circus. And your management team gets tired and you get distracted from the business. In my experience, if you go for a handful, call it 3, 4, 5, maybe 6, good quality prospective buyers, you can give them more time and the attention they need to recognize the value that you have and still spend time on your business. And buyers are smart. They know, or they sense, if they're one of 10, they're not going to be that interested. But if they're one of 4, yeah, you know what? Maybe they'll lean in a bit because there's a good chance. So it is about a good balance. And you have to convey information to them, right? The information memorandum, a data room that gets set up afterwards, management presentations. But remember this, it is importantly a two-way street. You want to get information from the buyer as well as provide them with information. What do you want to get from the buyer? Well, understanding their business, the strategic fit, and other elements. Because ultimately, it's going to come down to negotiation. And negotiation is about knowledge. So the more you understand about the buyer and why they want the business and how they're going to operate it, the better you are to negotiate a deal that reflects the upper end of what a buyer is willing to pay. So what are some of the things that go wrong in this buyer information exchange? Well, sometimes you engage the wrong person, right? You call the Canadian president of a multinational, and sometimes he or she can't get up the flagpole because it has to be approved by somebody else in the organization. So while they may be very helpful at a local level, you've got to know who the ultimate decision makers are. Mismanaging the auction, right? So too many potential buyers, or just dealing with one buyer, and the question becomes, well, if you want a horse to run fast, you got to put another horse beside them. Strategic versus private equity firms. There are literally thousands of private equity firms that are sitting out there, and within my organization, we have what we call coverage officers that actively cover 600 of them in North America, and that's the tip of the iceberg. No shortage of private equity firms that want food companies, but is it the right choice for you as a seller? Well, again, that depends. It depends on the nature of your business. It depends if you want to cash some chips out and keep some chips in and ride the wave. It depends on your management team. So again, it's not a right or a wrong, but recognize the lens is different. If you're dealing with private equity firms, recognize they don't want to get into anything they can't get out of. So they're looking typically for a few things. A strong management team, because typically they don't want to be doing the day-to-day management. They want to be on the board, but not the management. And they want to see growth, right? So they want to see the ability to get from here to here. And they want to see, okay, once we've done that, who's going to buy it? The exit strategy. So a different lens than a strategic that's thinking of a longer term horizon and more integration with their existing operations. The letter of intent is that, as we'll talk about it, the LOI is a key pivot point, and I'll get to that in a second, but you've got to ensure that if there's any challenges in your business, anything that needs to be addressed, you got to do it before the letter of intent and not afterwards. And I'll come back to that. You've also got disclosing information too early. So look, if you tell somebody your revenues and your gross profit on an aggregate level, kind of interesting information, but not much they can do with it. But if you tell them you're selling this SKU to Sobeys for this much, hey, You know what? That's a problem, and you want to keep that sensitivity till after a letter of intent and you're dealing with a single buyer. And management presentation is always key. We spend a lot of time working with sellers on how to present because, you know, ultimately the M&A game is like a combination of three things. It's like Sudoku, the Japanese number puzzle, because all the numbers have to fit together. It's like chess because it's strategic, and it's like poker, right? So you don't want to tip your hand. You don't want to give the other side, the buyer, a sense that they are the only buyer, they're the lead buyer. So there's just ways to phrase things and so on to ensure that you're not tipping your hand. Also, within any presentation, you know, in an ideal world, you know, the business owner takes a back seat because the buyer is looking at the business owner and says, hey, if I put, you know, 20, 50, whatever $1 million in your pocket, you know, you can make promises, but you can bugger off and put your toes in the sand and have your umbrella drink. Who's going to run this business? So ideally, the business owner stands up, talks about the history of the business, turns it over to the key management team and say, you know what? 5 years ago, I hired these people. Now I just play golf half the time. Fantastic, right? Because those people are the ones going to run the business. So, and again, don't make it a one-way street. Make sure you're getting information from the buyer as well as giving them information. Then it comes to the real discussion. How much for the business and on what terms? Just as important. The terms of any deal are just as important as the price. So in that regard, you have really three issues. Are you selling assets or shares? Now, buyers usually like to buy assets, but as a practical matter, most deals are share deals. Why? Well, more tax efficient for the seller in most cases, but also there's an element of simplicity in a share deal. I mean, you have a whole bunch of contracts that if you buy the assets, you got to go through every single customer and so on and say, can you renew this contract with us? That exposes both the seller and the buyer to renegotiation. You've got to go to every single employee and say, you got to sign up for a new contract. So all of these things make selling assets problematic in a lot of cases, especially for food companies. So share deals are more common. Of course, there's risk of hidden liabilities, but that can usually be handled either through representation of warranty insurance or holdbacks or other mechanisms. Forms and terms of payment. Every dollar not received at the closing of a transaction is a dollar at risk. You have to be satisfied the prospective reward is worth the risk. It's not about the highest price. It's about having a deal that is both economical from a risk reward perspective and tax efficient. It's about what you keep in your pocket, not the gross purchase price. If you're involved in the business, there'll probably also be a management contract to stick around for, I don't know, a year, 2 years, 3 years. These things vary depending on the person's individual wishes, the needs of the business, and so on, but they could come up. And of course, a big part of the deal structuring is that's when you're doing your negotiation. So you're negotiating that all-important letter of intent. And you're thinking about the tactics and the strategies to use and so on. And ultimately, it is about negotiation. Negotiation is the key. Despite all the economic voodoo, it's about the need and the desire to transact. So you really want to give a lot of emphasis to that letter of intent. While a letter of intent is non-binding, it sets the parameters for every single transaction. Do not underestimate the importance of that letter of intent. So what are some of the mistakes that buyers sometimes make when they're negotiating a letter of intent? Well, price and terms. So as I said before, a high price is not necessarily the best deal. Somebody could offer you a really great price, but it might be tax inefficient, or it might be on a whole bunch of deferred terms. By way of example, in today's environment where money is much more expensive than it was just 24 months ago, buyers will often use promissory notes. Well, there used to be a time where somebody said, I'll give you a promissory note with no interest, and that really didn't matter that much. Well, it matters today. So promissory notes are also risky because they rank behind the buyer's bank and other secured lenders. So even the payment of the promissory note has an element of risk to it. So you've got the interest rate, and if you do get interest on a promissory note, it's fully taxable. And you've got the promissory note collection issue, which may or may not come into play. The earnout. So a lot of times, buyers and sellers have different price expectations, as you might imagine, and they bridge the gap with an earnout. Well, an earnout, to a large degree, is simply the buyer saying to the seller, "Hey, I'll buy you out with your own money." Well, sometimes, in some ways, it is like that, but sometimes the necessary evil. And there are two fundamental types of earnouts, what I call comfort earnouts and incentive earnouts. So the comfort earnout is often used where maybe you have some big customer concentration. Maybe 3 customers are 80% of your business for whatever reason. So a buyer will say, look, you, Mr. and Mrs. Seller, have obviously a lot better comfort with the seller, the customers that you've got than we do. We need to ensure that these major customers stick around for a couple of years. So as long as they stick around and there's a certain threshold for their continued activity, we'll give you the money. We need that comfort. That's one. The other is the incentive earnout, where, of course, the seller says, well, look, I'm coming out of supply chain challenges and still, COVID hangover and this and that. And, I dipped and now I'm coming back up so I can get back up to that next level. And of course, the buyer, as rightfully they should be, the buyer's skeptical. And so the buyer says, look, we're going to pay you for the baseline what you have now. If and when you can grow the business to the next level, right? More revenue, more earnings, and so on, then we'll pay you extra. So it's that extra incentive. And so that's, the icing on top of the cake, if you will, or if it's part of your basic purchase price, then it's a question as to whether or not you're going to the market at the right time. Tax consequences, as I mentioned, every 3 parties to every transaction, you want to make sure that you maximize your after-tax proceeds. But what's really important in that letter of intent is that it be as clear and comprehensive as possible and cover off all the major commercial terms. So a letter of intent that comes around and says, hey, we'll give you 8 times EBITDA, it's garbage. Why? Because then you have to negotiate, what does EBITDA mean? Is it this year's, last year's average? Is it normalized, not normalized? What adjustments? So you're just setting yourself up for a lot of discussion and a lot of grief. It's got to be very specific. We are giving you $50 million for your business. And that $50 million is going to be for the shares. And we're going to pay you $40 million up front. And then there's an earnout, there's a note, etc. And here's the major provisions of those things. And by the way, our offer is conditional on us demonstrating that you generated at least $7 million of trailing EBITDA, if you will. So you as the seller have to be comfortable. Hey, am I satisfied that when somebody really puts the magnifying glass of this, they're going to see $7 million of trailing EBITDA? Because if not, the buyer's going to look and say, hey, you know what? You didn't hit that condition, so I'm cutting back on my purchase price. Look, if you can't negotiate a strong letter of intent, you will never negotiate a strong purchase agreement. The letter of intent is the point where the seller is at their peak power in terms of negotiating advantage. And exclusivity becomes key. So this next slide is the one that I believe is most important in any of my presentations. The concept is simple, but important. And it starts off and says, look, when you go to market, the seller has the advantage. They're going out to multiple parties and getting bids and so on. But at some point, a buyer wants exclusivity. And as soon as the seller grants that exclusivity, the tables turn. Why? Because after exclusivity, it becomes difficult, not impossible, but difficult for the seller to run back to a different buyer, right? Because the other buyer is going to say, well, what happened? Plus, after exclusivity, you're showing all of your detailed information. So you've got information risk, especially if you're dealing with a competitor. So what this means is that exclusivity is key. The seller's risk is between the time that exclusivity is granted and the deal closes. You want to minimize that and have a strong letter of intent. So, while it's not binding and a buyer can go outside of the lines, well, it's a little harder when you have the specifics in there. So protect yourself between those two. Closing of the deal, right? This is where the confirmatory due diligence happens. Don't underestimate the time that your management team is going to have to spend here. The purchase agreement, you need good legal counsel. And finally, closing. Most deals in Canada are signed and closed, unless you need to go through Competition Bureau review. And in Canada, the threshold is actually quite small. It's quite low. It's $100 million of revenue or other criteria. So a lot of food companies do have to go through this, and it does take a bit more time. You want to deal with a law firm that knows what they're doing, but you've got to stay focused on running the business while you're closing it. So why don't deals close? So 4 key reasons I find. Buyers and sellers have different expectations, right? What does 8 times EBITDA mean? It means something different to each party. The deal falls apart. New issues in confirmatory due diligence. If you've got any issues to be addressed, right? Be they customer issues, people issues, environmental issues, get them on the table, diffuse them before the letter of intent, because if they come up at the 11th hour, the seller's the one that's going to suffer. Material changes in the company's operations. You got to operate the business as usual as you're selling it. And it is not easy to do because people are distracted. But if you start having quality problems, losing customers and so on while you're trying to sell your business, that's not a good thing, because ultimately the value will go down, the buyer will walk or change their price or terms, and you're either left with the lower price or alternatively, you're having a business that is much less valuable. And finally, external circumstances. Things happen. COVID happened quickly. The 2008 credit crisis happened quickly. You can't control these things. But what you can control is the period of time between exclusivity and closing. Keep it as short as possible. Work expands to meet the time allowed for its completion. So the shorter that period is, you can always extend it. You can always agree to extend, but you want to keep it tight and keep everybody focused. So let me spend the next little bit, maybe 10 minutes or so, just talking about the buy side with a handful of slides, because it's obviously the different lens of what we've talked about so far. And so on the buy side, I like to look at it as this circuit. And I want to emphasize that it starts with a good corporate strategy. Far too often buyers, are reactive to acquisition opportunities that come their way. And if you do that, then you have to question whether or not it fits into your overall strategy. So the strategy should look at acquisitions as just one avenue for achieving your objectives. You could joint venture, you could build rather than buy. There's a whole bunch of other ways. Acquisitions have to either, compensate for some of your weaknesses or add to your strengths. So that will help you when you have that good corporate strategy. Say, hey, what do we want an acquisition candidate to look like? And it helps to put down on one page, right? So geography, customer type, products, unionized, non-unionized. It's like buying a house, right? It's got to be quiet court, 4 bedrooms, this, that. There's the must-haves and the should-haves. And again, acquisition targets are like that. And it's not cast in stone. Things can change. But you got to ask yourself, if you've got these must-haves and then something comes along that doesn't meet them, if you're going to look at it anyway, you've got to question why you have those must-haves. Of course, you do your analysis. So now you're on the receiving end of the information memorandum and data room and so on, evaluation and pricing, and then negotiating the letter of intent. And of course, you're on the opposite side. So the buyer, of course, wants exclusivity early. They want ambiguity in the letter of intent because that time between letter of intent and closing is their strength. So this is where heads butt, right? The seller is trying to push for as much specificity as possible and as short as time as possible, whereas the buyer is trying to give themselves more time and less specificity. So ultimately, the two have to coincide. Confirmatory due diligence, right? Always a big undertaking and an expensive one. So you've got to be sure about what you want to acquire. The closing, and importantly, the integration. And the integration, while it's the last point here, I'm telling you, it's one of the first things that buyers should think about when they're looking at acquiring a business. Because if you can't integrate a business, don't buy it. The easiest way to buy a small business is to buy a big one and to mess it up. And it usually messes it up through integration. So, what are some of the errors on the buyer side that we commonly see in food companies? Well, certainly really understanding historical results. And we all know that, food companies in particular, many of them have foreign exchange considerations. You're either buying inputs or ingredients in foreign currency, or you're selling to customers in the US or overseas. And these things, of course, influence revenue and profitability. So it's really good to have a good understanding to say how much of that revenue and profitability variance is attributable to foreign exchange, which is beyond your control. Yes, you can have forward contracts and so on, but remember, those are short-term solutions. And so you've really got to understand the longer-term trends. Scrutinizing the forecast. You're going to get forecasts from the seller, and despite choppiness in history, everything's going to be rosy when you look forward. Well, the problem with forecasts isn't the optimism necessarily in terms of the growth, it's the internal inconsistency. So ask yourself, okay, if this company is going to grow by 10% a year for the next 5 years, what capital spending do we need? Right? More equipment, more trucks, capacity utilization. So that's cash flow, that's a drain on value. And of course, how much working capital am I going to need? More receivables, more inventories. This is also a drain on cash flow. Working capital is after-tax dollars stuck in the business. So to the extent you have to finance that to finance growth, it actually retracts from value. So growth and value are two distinct concepts. A growing company is not necessarily more valuable than one that is stable or growing modestly. Ignoring the balance sheet. Remember I said when you're a seller, you really want to maximize the value for the brands and the people and the customers and so on. Well, now that you're the buyer, you want to do exactly the opposite. Why? Because intangible value to a buyer is risk. And it's risk because, it's stuff that can disappear overnight. If you pay $50 million for a business and most of that is backed by good quality receivables, inventory, fixed assets, there's some risks you might not fully realize on those, but it's kind of mitigated. Chances are you're going to collect the receivables, realize the inventory, and so on. But if you're paying a whole bunch for intangible value, especially things like people and customers, boom, it can be gone overnight. Right? People walk out the door, take customers with them, etc., or damage customer relationships. That goodwill could really be written down quickly. So that's another key battleground, is the intangible value. Sellers want to maximize it, and buyers want to minimize what they're paying for goodwill because it could easily disappear. And synergies. Everybody loves synergies. And yes, if I buy this business, I'll consolidate warehouses and so on. All great. But whatever you think synergies are going to be, cut them in half and figure it's going to take twice as long, because that is reality. Then don't forget there are negative synergies. For example, what if you have a better employee benefit program in the company you're buying, which is often the case when you're buying a smaller business? Now, all of a sudden, you have to give all these people that you bought a better benefit program. That's a cost. There's integration costs with respect to your systems, your people, everything else. So don't underestimate the economic impact of buying a business. Integration is repeatedly cited as one of the key risks when buying a business. Easy to buy a business, right? You just pay more money than anybody else. But can you make it work? And the areas you have to really look for are what I call transition risk. That is, if you buy a business and you transition it to your business, then what do you lose? And again, it's key contracts. So look at those contracts. Look at the contracts for your retailers, your distributors, and others. Oftentimes they have change of control provisions, even if you buy shares. Some just require consent. Others are going to actually ask you you're going to have to ask permission. Well, that's a risk. Losing key people. And that's why a lot of buyers want to say, hey, part of the purchase price is actually going to be set aside to pay these key people to stick around for the next 3 years, because without the chief operating officer and the chief marketing officer and so on, this business isn't worth as much. And a smart seller is going to recognize that and agree. Changing culture. Culture is an elusive concept. So at the end of the day, how do you get the two cultures to fit together? right? It's really tough to gauge when you're only seeing the tip of the iceberg. But somehow you have to manage to figure out, are these cultures compatible? They may not be the same, but they have to be compatible. Losing extra revenue, because you lose customers, damaging the brands because people are talking about, how, going from a small business, small mom and pop business to a big corporation is going to mess up the service, and inadequate communication, right? There's a lot of anxiety when you buy a business, not just among the employees you're buying, but actually sometimes among your existing employees. You got to communicate. You got to have the plan. If there's need for layoffs and so on, you got to be clear about it. You got to be fair about it. You got to dismiss it, because that nervousness and anxiety is really what catches up with you. The irony is, when you're buying a business, employees afraid that they're going to get fired, and usually the buyer is afraid that the employees are going to leave. So what happens? Well, the good people leave because they can find a different job, and the kind of mediocre people, they stick around. So it's not good for anybody. So be very sensitive about the communication strategy. Spend a lot of time on that. 100-day plan is usually one of the key elements, right? The first 100 days, what are you doing? Who's talking to who, etc. Manage it carefully. So a couple of last slides before we move on to questions. What doesn't work in mergers and acquisitions or on the buy side? Well, not assessing strategic fit up front, right? Easy to buy the business, but does it fit? Those unrealized synergies, whatever you think you're going to generate, chop it in half and figure it's going to take twice as long. Strategic value. If you start justifying strategic value, that is code for reaching for some elusive concept to justify a higher price. Now, when I'm selling a business, I love a buyer to talk about strategic value. But as a practical matter, when we're advising the buyers, we're saying, look, if you can't talk about real cash flow or risk mitigation, then how do you get value? Falling in love with the deal, right? You've worked hard on it and so on, and you paid $250,000 worth of cost to lawyers and accountants and everybody else. Tough to walk away, but better to walk away from $250,000 than $25 million. Inadequate due diligence, taking shortcuts, right? It's expensive. People make errors in technical analysis. It's incredible how often spreadsheets contain errors. Poor integration, as I said, one of the most common reasons for deal failure. Cultural differences, again, very elusive, but is really out there. Hidden costs, you've got to allow yourself some cushion, because there are always costs you didn't anticipate when you're doing an acquisition. And if you pay for the last dollar, there's no cushion. And losing key people. You lose key people, you lose key customers, and ultimately everything starts to unravel quickly. So that being near the end of this presentation, and I know that's kind of like drinking from a fire hose, because there's a lot to know. Actually, those that are really interested, I do a day-long or 8-hour course with CPA Ontario that's available to both CPAs and the general public on mergers and acquisitions from start to finish, and anybody across the country can join. So somewhere on the CPA Ontario website, that's available if you're interested. I think the next one is in November, if you really want to get into more of the detail. But for those of you that are looking for some bedtime reading, I spent a lot of time on airplanes in my career writing books, and most of them are published by the Chartered Professional Accountants of Canada. I put them all into one collective little website called stratplan.ca. But if you're interested in selling a business, buying a business, or just generally how do I increase the value of my business, these are resources that will hopefully be of help to you. So you can go on there, and if you're interested, just take the next steps. So with only a few minutes left, and as I said, if we run out of time here, you're welcome to email me or call me with questions. But Alex, do we have any questions from our audience?
We do. We have one right away from the audience here. It says, on a high level, what do you think happened to the White's transaction or lack thereof?
A great question. It was an unfortunate situation. It was, so White's, of course, was Smucker's, your pickles. And that one, they also did a lot of work with Bix. It is now public knowledge that the Bix brands were acquired by Treehouse, and that left very little, unfortunately, for whites. And I think that that was a large part of its demise, as well as just some unfortunate timing and so on. They did have a big, beautiful facility, but they opened that up right at the outset of COVID. So it was just unfortunate timing in many cases, and sad to see, but it's a reality.
Yeah, absolutely. Thanks, Harold. I got another one here. What should I do if I'm approached by a prospective buyer?
Well, a lot of times you get a situation where the business owner says, look, I'm not thinking of selling, but I got a knock on my door. And a buyer wants to talk. Should I talk to them and so on? The answer is yes, no harm in doing that. But first of all, make certain that they're worthwhile. Business owners are inundated, probably get 3, 4, or 5 calls a week from somebody saying, I want to buy your business. I've got a buyer for your business and so on. A lot of fishing. You can spend oodles of time going down the rabbit hole, and it becomes very, very problematic because you got a business to run. So the first thing you want to do is make sure that you're dealing with a credible counterparty. Right? So a lot of outreaches are from junior associates at private equity firms, and chances are it's a large fishing expedition. You can certainly entertain it, but just be wary. Usually the more serious outreaches come directly from a buyer and at a very senior level, such as a CEO or something similar. And it doesn't hurt to have a conversation with them, but a couple things. Number one, get a non-disclosure agreement up front. And number two, make sure that you understand their perspective. Why do they want your business? And that they are also giving you the time to think and reflect and get the advice that you need. And don't lock into exclusivity too early. Right? A lot of buyers saying, well, we've taken a look at your 50 million in revenues and so on. Well, here's a letter saying we're exclusive for the next 60 days so we can check this out. No, don't do that. Right. Take it step by step. If a buyer doesn't want to give you time, then they're looking for a bargain price, not worth it. But so be cautious, but go ahead and talk.
Right on. Thank you. Another one from the audience here. What are some of the headwinds and tailwinds to watch out for in the market that could impact food business profitability and cash flows?
Well, certainly on the food side, we're seeing a couple of the headwinds. Obviously, we have the very public challenge right now with all the grocery chains, which are going to turn around to their suppliers and say, geez, we're getting pressure not to raise our prices, so you can't raise your prices. Right? Meanwhile, now on the ingredient side, we're still seeing that going up. So as we know, a lot of the ingredients come from different countries overseas, and they're going to say, well, we don't care if your Canadian government is putting pressure on you. You want these ingredients, you got to pay up, or somebody else wants them. So we are still seeing some, although not as much, ingredient inflation. I mean, look, it wasn't so long ago that shipments, containers coming from China went from 4,000 to 28,000, and now have gravitated way much lower, but not still as low. We have geopolitical risks, right? So some of the inputs coming from those parts of the world are also in shorter supply and prices going up. So there is price pressure. There's clearly labor pressure, right? We've seen the pressure on strikes. We've seen a lot of labor action, and we've seen in a lot of provinces even minimum wage going up, which elevates the wages for everybody. So I think that processors will continue to have input cost challenges at a time when end consumers and therefore major retailers are putting pressure to keep prices where they are. So we do see a potential squeeze on margins, which means we're going to see probably a lot of automation for efficiency. And a lot of people are going to say, look, that new packaging machine, for $1 million or whatever it might cost, a line of packaging machines, that's going to save me X number of people and so on. Now the payback is 2 years. So I think you will see automation being a necessary step for a lot of companies just to remain competitive.
Right on. Thank you, Howard. Get a couple more here. Can you please elaborate on the mechanics of how earnouts work?
So earnouts, as I mentioned, there's two different things. Earnouts, there's comfort earnouts, and there are incentive earnouts. But ultimately, you have to agree on five variables. So number one, what's the measurement? Is it revenues? Is it profitability? Sellers always want revenues, whereas buyers usually want something deeper in the balance sheet. And the seller will say, well, how much control do I have that? So there's always that discussion. There is the time period, right? Is it 1 year, 2 years, 5 years? The longer the earnout, the less likely it is you're going to get paid near the tail end. You've also got to look at the, is there a minimum maximum? So a lot of earnouts are structured as cliff payments. So we'll give you an extra 2 million if you hit 50 million in revenues next year. We'll give you $1 million if you're at least 45 million in revenue. But if you're less than that, we give you 0. So watch for that cliff. Tax issues. If you structure the earnout incorrectly, you turn a capital gain into ordinary income. And that's always dangerous. Right? And then you got payment provisions, right? Because oftentimes the buyer has to go to the their bank to get consent to actually pay the earnout payment and still be within their covenant. So earnouts, even if you earn the money, there could still be some collection risk. So again, a lot of variables and a lot of risk with earnouts. Not that they shouldn't be used, and they're very common, but you have to weigh them very carefully.
Awesome. All right. Well, thank you, Howard. It looks like we're just running out of time here. So I just wanted to thank you for that wonderful presentation. It was chock full of information. Really appreciate that. Wanted to extend one final thank you to Dr. Howard for being here today, as one final thank you for our sponsor of today's webinar, Kroll. And thank you to all of you for all your questions. Really appreciate everyone's participation. Thank you, everyone, and have a great day.
Thank you.
Thanks, Howard.